Hello and welcome back to Volatility 411. I'm Kevin Davitt, part of Cboe's Options Institute, and it's Monday, January 24th. Now we're coming off the worst week for U.S. equity indices in many months. The S&P 500 declined by nearly 6%. It was the third down week in a row and the worst week for the large cap benchmark since March of 2020. The VIX Index closed the week just below 29 and is higher by another 7 points today. So as I stand here, the VIX Index is measuring around 36 and change. The VIX futures term structure is inverted, which is unusual. In other words, the February contract, which is the nearest standard future, is trading around $1.50 over the March standard futures. Last year, there were a few brief VIX term structure inversions, but there hasn't been a prolonged backwardation since March of 2020, adding to the potential concern, at least for technical type traders. The S&P 500 is now well below its 200-day simple moving average, and the last time it broke that longer-term support was late February, early March of 2020. Now at this point, the concerns are less COVID and more interest rate and valuation driven. The prospect of higher rates and the potential for slower growth going forward has pushed equities across the board lower. Technology and small cap names have been hit particularly hard. This week, there will be a Federal Reserve meeting with a decision and a press conference on Wednesday. As it stands, the VIX Index is near the highest levels in a year. The last time it was around 36 was during the meme-driven short stock squeeze from a year ago. Now, at the money SPX options with a month to go are pricing on a nearly 30 vol, and that means that the S&P 500 index option market is pricing daily moves of about 2%. We'll see if that continues to materialize or if this too passes quickly. That's Volatility 411 for Monday. Thank you very much for tuning in.